All right, let's get right into it. Welcome to this explainer where we're taking the consumer giant Procter Gamble and putting it through the absolute ultimate investment gauntlet. As an investment analyst, what I want to do today is strip away all the market noise, look purely at the raw data, and see exactly how P&G holds up when we apply the legendary frameworks of the world's greatest investors. Let's find out if this is a buy.
So here's our roadmap for today. We'll start with a quick company snapshot, then view the stock through the Warren Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll run some modern DCF valuation models and finally wrap it all up with a synthesis and final verdict.
Section 1. Company Snapshot. Meet the contender. Okay, so you probably already know P&G, right? They are a deeply diversified, absolute global leader in home and personal care. We're talking about the powerhouse behind massive household staples, think Pampers, Tide, Gillette. They have boots on the ground operating in about 70 countries, competing across every tier from super premium down to value. Honestly, when you walk down a grocery store aisle literally anywhere in the world, you are walking right past their economic engine.
Let's look at the baseline financials we pulled from recent DBS Bank data. The stock is currently sitting at $147.26. To put their sheer size into perspective, they've got a massive $339.7 billion market cap, and they offer a highly respectable 2.9% dividend yield. But check out those multiples. We're looking at a forward price-to-earnings ratio of 20.7 and a price-to-book of 6.5. It's pretty clear right off the bat that the market is absolutely pricing in a premium for safety here.
And their revenue breakdown shows us exactly why they're considered so safe. The diversification is massive. Fabric care is leading the charge, pulling in 23% of net sales. Then you have home care at 12%, with baby, hair, and family care each carving out a solid 9%. This is definitely not a one-trick pony. It is a deeply entrenched, highly diversified cash machine.
Section 2. The Warren Buffett Lens, Moats and Management. So, applying the Buffett framework, the very first thing we look for is an economic moat. And P&G's moat? It's undeniable. It's built entirely on premium brand dominance across those 70 countries, backed by heavily targeted global marketing investments. Their sheer scale, combined with a highly data-driven supply chain, makes it incredibly difficult, maybe even impossible, for a new entrant to just swoop in and steal significant market share.
Now, running them through Buffett's quality checklist, P&G passes with absolute flying colors. I mean, look at this, a phenomenal 31.8% return on equity. That tells us management is incredibly efficient with shareholder capital. Their net debt to equity is sitting at a totally manageable 49.6%. And here's the kicker, perhaps the most important metric for Buffett, owner earnings. P&G projects converting a staggering 85 to 90% of its earnings straight into cash flow. From a pure business quality standpoint, Buffett would absolutely love this company. But would he pay $147 a share for it? Well, hold that thought. We'll get back to that in our final synthesis.
Section 3. The Peter Lynch Lens, Growth versus Price.
Shifting gears to Peter Lynch, P&G perfectly fits into his classic stalwart category. These are the big, established players. With a stalwart, we can expect moderate growth, sure, but what we're really buying is reliable downside protection during recessions, plus the fact that they project paying out around $10 billion in dividends alone. But, as Lynch always warned his readers, you still have to watch the price you pay, even for a fantastic stalwart.
And that's where things get a bit tricky. While Lynch would absolutely love their sturdy balance sheet and that recent 7% EPS growth, the valuation is a real hurdle here. If we take that forward PE of 20.7 and divide it by that rough growth rate of 7%, we get a PEG ratio near 2.95. Lynch typically wanted to see a PEG closer to 1 to signify a true bargain. So, looking through this specific lens, the current growth rate doesn't quite justify the premium price tag.
Section 4. The Benjamin Graham Lens, Deep Value and Margin of Safety.
All right, time to face the harshest critic in our gauntlet. Benjamin Graham, the father of deep value investing. Running P&G through his defensive investor checklist, they easily passed the adequate size test with that $339 billion market cap. They easily pass the strong finances and dividend record tests too, but they completely fail his requirement for moderate valuations. Graham strictly wanted a PE under 15 and a price to book under 1.5. At a PE of 20.7 and a PB of 6.5, Graham would immediately raise a massive red flag.
So to find out exactly how overpriced this stock is for a strict, deep value investor, we have to actually run the math on Graham's famous intrinsic value formula. This is where the numbers get really fascinating.
Okay, let's plug the data in. We take the square root of 22.5, multiply that by an estimated annualized EPS of $7.14, and multiply that by an implied book value per share of $22.65. The output? A shockingly strict intrinsic value of just $60.32. With the stock currently trading up around $147, there is absolutely zero margin of safety for a Graham value investor. None.
Section 5. DCF Valuation and Alternative Models. Let's move beyond the classic gurus and run the modern Wall Street math by building a discounted cash flow analysis. We are forecasting those incredible free cash flows based on their stated 85% conversion rate. Now, since the exact weighted average cost of capital isn't explicitly listed in our source data, we're making a logical assumption here, a standard 7.5% discount rate, which is super appropriate for a mature consumer staples risk profile. We'll pair that with a 2% terminal growth rate to model their steady cash flows tracking along with long-term GDP.
When we run a standard sensitivity matrix on those numbers, we see that minor, realistic tweaks to our discount rate or our growth assumptions keep P&G's fair value hovering very, very close to its current trading range. So, on a pure discounted cash flow basis, the stock is essentially fairly valued today, but only if you fully accept that their premium market position is a permanent given.
By comparison, when we look at alternative Wall Street models using comparable PE multiples and EV to EBITDA projections, the consensus target, along with DBS Bank's 12-month target, lands right around $163 to $164. That implies roughly a 10.7% upside from here. Basically, Wall Street is betting heavily on P&G's continuous market share momentum rather than looking for a deep value bargain.
Section 6. Synthesis and Final Recommendation. All right, we've run the ultimate gauntlet. Let's look at the final scorecard, which reveals a pretty sharp split decision. Benjamin Graham's math screams sell with that intrinsic value of around $60. Peter Lynch suggests a hold because of the high PEJ ratio. Warren Buffett would certainly acknowledge the tremendous business quality, but he'd likely hold too, waiting for a better margin of safety. Meanwhile, modern analysts see that upside momentum and confidently rated a buy at $163. It is a literal textbook case. Classic value investors see a stock price for perfection, while modern analysts are betting on the momentum of unmatched quality.
Ultimately, it comes down to balancing two very different realities. On one side, P&G's strengths are just undeniable. They have an unmatched global moat, a 31.8% ROE, and gargantuan cash generation. But on the flip side, the risks are almost entirely about price and macro factors. You have those high valuation multiples, foreign exchange headwinds, and all the geopolitical uncertainties that come with operating in 70 different markets. So blending all these frameworks together, my verdict as an analyst is that Procter & Gamble is a solid hold today at $147.26. Actually, let me rephrase that. It's a phenomenal, sleep-well-at-night business, but the current price just offers very little room for error. The strategic move here is to keep this right at the top of your watch list and look to buy aggressively during broader market pullbacks when those multiples compress closer to their historical averages. Right now, its absolute primary appeal is for conservative dividend investors who just want that 2.9% stability.
It really is the ultimate battle of business quality versus valuation math. You have a world-class operator, but it's trading at a serious premium. So I want to leave you with this to ponder. Considering the power of these brands that are probably sitting in your own home right now versus the incredibly strict numbers we ran today, at what specific price point would you feel comfortable pulling the trigger on Procter & Gamble? Thanks so much for joining me on this explainer, and keep analyzing.